Welcome to Klingenstein Fields Investment Advisors. My name is Susan Curry, and I'm the Chief Operating Officer at Klingenstein Fields Advisors. I'm here today with Greg Galinsky, Head of Analytics and Risk Management at the firm. Greg, it's certainly been an interesting couple of weeks. Can you fill us in on the performance of the markets here today?
Absolutely. Markets began the year on relatively stable footing, but were quickly disrupted by a new round of tariff announcements. The S&P has fallen nearly 8% year to date amid choppy trading, with similar volatility in international equity and bond markets. Rapid shifts in policy have introduced a renewed sense of uncertainty, prompting sharper market reactions.
What's been driving such a strong reaction to the tariffs?
The administration had previously signaled a tougher trade stance, but the size and scope of the tariffs announced in April were more significant than expected. A baseline tariff of about 10% was introduced, with appreciably higher rates for countries with large trade imbalances or protectionist policies. While some of the tariffs have since been delayed, the unpredictability of policy changes has made it difficult for businesses and the markets to adjust.
What are the broader economic concerns related to tariffs, and how has this impacted the outlook for growth, inflation, and interest rates?
Tariffs are having a ripple effect across the economy. They increase costs for consumers, complicate corporate planning, and put pressure on profit margins. In some cases, companies may respond by cutting costs through layoffs, which could weaken the labor market. There's also the risk of escalating trade tensions, which could further weigh on economic growth and raise chances of a recession. Because of this, the proposed tariffs are contributing to rising inflation expectations and slightly weaker economic metrics. Forecasts for 2025 inflation have climbed by nearly 1% over the last 6 months, while projections for GDP and consumer spending have been revised slightly lower. Interestingly, despite the higher inflation, which would normally lead to higher interest rates, market expectations for Fed rate cuts have increased from 1 to possibly 3 cuts this year by December, as investors anticipate a more accommodative policy if growth slows. Still, there's a high degree of uncertainty, and forecasts are likely to evolve a great deal over time.
How have equity valuations changed in response to this?
The recent market pullback has brought equity market valuations down, with the S&P 500 price to earnings decreasing from 22.4% to approximately 19.6%. That's still modestly above long-term averages. What remains uncertain is how much recent policy changes will affect corporate earnings over the coming quarters. If earnings expectations deteriorate further, valuations could drift higher, making stocks appear more expensive. That said, while near-term earnings may face pressure, we expect the longer-term earnings trajectory to ultimately revert towards its historical long-term growth average.
So how should investors be thinking about the recent market swings, and what's our message to clients who are understandably concerned?
The short term is always hard to predict, especially in a volatile policy market like we're in today. But history does offer some perspective. Markets have recovered strongly from past disruptions, whether it was the tech bubble, the financial crisis, or the COVID-19 downturn. Sharp sell-offs like this are rare, but not unprecedented, and the more important question is what happens next. Historically, 5 and 10-year returns following major declines have been quite strong. That's why we emphasize staying invested, maintaining diversification, and avoiding emotional reactions, while also being prepared to make thoughtful tactical adjustments as the situation determines.
So what should investors be focused on in the weeks ahead?
Expect continued volatility as policy unfolds and sentiment shifts. The 9.5% rally after the recent 90-day tariff pause shows how sensitive markets are. That's why we emphasize diversification, discipline, long-term focus, and staying alert to both risks and opportunities.
Thanks, Greg, for this helpful perspective. As always, we encourage you to reach out to us with any questions or requests for additional information.